Step into the metalverse, a vast, ever-evolving realm where industrial metals take shape amidst shifting prices, market trends, and supply chain forces. But what does it all mean for you? Welcome to Cup of Joe. Named in honor of our founder, Joseph T. Ryerson, we help you navigate the metalverse, one conversation at a time.
Welcome in, everybody, to another special edition here of Cup of Joe. As has been the normal here in the last, I'd say, month or so. We've been doing our regular episode, and then we've been caught off guard by some news coming in. And sure enough, after our latest episode of Cup of Joe, Nick, right, we had some rather big news on a Sunday. Now, Trump tends to make these announcements on Sunday. I remember on a Super Bowl Sunday when the original announcement came out. Yes, there's no day off when it comes to tariffs, right?
Yeah, we got some zingers. We thought trade deals were coming. We did not predict where they were coming from, and we'll get into that here in just a few. I've actually got some slides I'll pull up just to kick off the content. But yeah, a lot's been coming our way just in the last 2 weeks since we last recorded Cup of Joe. As we always have to do, I do want to quickly run through the legalese, which is these are the opinions of Nick Webb and Mike Carrazzo. These are not the opinions of Ryerson. Do your own research, all those things. But we got some updates over the last week or so that I think viewers are certainly going to want to be aware of, and perhaps the most important, the implications to what that may mean for metals markets and availability of goods.
Yeah.
So 2 weeks ago, I was referencing Scott Bessent, so these were not my thoughts, but this is Scott Bessent, the Treasury Secretary, who, and I used this exact same slide 2 weeks ago. He said, think of it this way: there are 18 countries that we have primary trade deals with, or trade relationships with. He said, take China, throw them to the side, and then we're going to focus on the other 17. That's almost verbatim how he said it was: ignore China, focus on the other 17, and those are the ones we're going to get trade deals with more quickly. And I had highlighted 2 weeks ago that Japan, South Korea, and India were the ones that were being referenced as those nations under which we would most likely get the first trade deals. Well, how wrong I was, and how wrong Scott Bessent was when he made that commentary, because the first trade deal that we got, which was about a week ago, was a bit of a nothing burger, I would say. It was with the United Kingdom.
Yeah.
You can see they're not even on this list of countries because the numbers, the notional value of the trade is so small. And interestingly enough, we don't even have a trade deficit with the United Kingdom. We actually have a trade surplus with the United Kingdom. So you kind of have to scratch your head a little bit and say, well, was there even an issue to begin with? We actually were exporting more to them than they were exporting to us. But nonetheless, it kicked off the trade deal rhetoric. And there were a couple important things that I think we can pull from just that United Kingdom bit of detail, which is, despite the fact that they are obviously a very important ally of the United States, and we don't even have a trade deficit with them, we still ended those discussions with it's a memorandum of understanding, but it's we actually are putting in place 10% tariffs on their goods. So even with our best ally, they're basically saying the floor to what we should expect for these other nations, I think, is somewhere around 10%. That's kind of best case scenario is what we can expect with these other nations here on this list. There were a couple exemptions, so things that are, I would say, hyper important to supply chains for the United States. Things like jet engines coming out of Rolls-Royce, those are getting exempted. But it gave us a little bit of a glimpse into what a blueprint might look like for both ally and non-ally nations, and that is that best case scenario looks like, while there may be some exemptions, best case looks like it's going to be somewhere around 10% tariffs baseline for most goods.
Do you think that was sort of like intentional? Not to get the inside baseball too much, but you think like, hey, okay, here's a template. Let's do it with the UK, so maybe it at least puts out, what it might look like.
It certainly feels that way. I think we would be foolish not to look at that as a potential blueprint for what we would be expecting. And I think that's a good transition into, on Sunday, we got the announcement that we were pausing the discussions with China and actually bringing the tariffs all the way down to, and this number should sound familiar, 10% on all goods for trade-related matters, and then 20% with regards to fentanyl. So summing those together, it puts us at a 30% rate. So you can see, if you've got the visuals here, we went from a starting point in February of 10%, went all the way up to 145%, and then took the elevator down on Sunday to a temporary 90-day reprieve of tariffs, bringing them back down to 10% for all goods and then 20% for fentanyl. The reason why I'm saying it that way is just because as we think about the UK deal, if we read forward through the next several months, theoretically, if China were to take significant action around the fentanyl trade coming into the United States, I don't know whether that's going to be deaths or somehow tracking imports of this sort of thing. If they were to appease the administration around that, that puts China all the way back down at 10%. If you omit that 20%. So, coming back to your question of, is the UK a blueprint for what we could expect? It certainly looks that way, because the only reason China's not even at 10% right now is just because of the fentanyl adder on top of that. But, I think the 90-day reprieve, my hope is, and I think the market's expectation for now, is that 90 days is going to turn into something a little more permanent. This is sort of getting into the rumor mill, but my understanding is that when Walmart and Target and all the other big retailers went to go visit the White House, my understanding is that their discussion was essentially, hey, if you leave these tariffs of 145% in place for another couple months, say goodbye to things like back to school shopping, say goodbye to, holiday shopping, because
Sure.
as I understand it, a lot of retailers around the May-June timeframe do a lot of their purchases for things like that. So it's interesting that we have to be thinking about year-end consumption, but just given the length of those supply chains, if resolution wasn't going to be on the table with China, we could have been at risk of seeing some pretty major inflation and maybe even some shortages of goods.
Do you think it? I don't want to get ahead of your slides here too much. Do you think it staves off any kind of inflation talk for the rest of the year?
I think it certainly does, and yeah, I've got a slide on that. I think it potentially staves off inflationary risks. I think it potentially staves off recessionary fears. And yeah, perhaps not coincidentally, and I've got a slide on it, but Goldman Sachs, about a day or two after the announcement of bringing these back down to 30%, they dropped their recession probabilities. So yeah, I think these things are certainly fluid, and it is worth noting that there is a chance that it could get ratcheted back up higher. A lot of this is a bit of a rigmarole, if you will, where, if China says something or does something that angers the administration, you could potentially see that risking tariffs going back up.
Sure.
The hope is that this is a bit of an all clear, at least for China, because they're such a large trading partner. At 145%, and I think they had 125% on us, you basically have a trade embargo. Nothing's going to get done at those types of levels.
Remind me again, how much do we import from China?
I don't have the exact number in front of me, but I want to say it's like $400 or $500 billion.
Okay.
The total number across all countries in 2024 was about $3.4 trillion. So,
Okay.
but China is a very large piece of that, obviously.
Number one?
They are number one, I believe.
Number one.
Yep.
Okay. All right.
Yep. And yeah, I mean, you took the wind right out of my sails on that. And I'm not going to run through all the verbiage here, but essentially, because of the removal, albeit temporary for now, of the massive tariffs on China, Goldman did reduce their recession fears. And I would say similarly, I think any economist has got to say, okay, our fears of stockouts, massive inflation have to be eased a bit as well. Now,
Sorry about that.
I'm going to run. No, you're good. I'm going to run through about 4 or 5 different charts. They're all going to tell a similar story, but it's really harkening back to this concept of the tariff roller coaster and what it's done to markets. This is looking at the S&P 500, so basically stocks. Going back to the beginning of the year, you can see we started off the year performing decently well, and then Liberation Day kind of shocked everybody, and we ended up going into a bear market, which is a market that goes down more than 20%. And then as we've seen Scott Bessent and some of the cooler heads prevailing within the market, we've seen a pretty significant rally. And wildly enough, as we sit here today, we are now in positive territory after being down about 20% on the year. We're back in positive territory for the broad stock market indices. So wild little trip there. A lot of these charts are going to look similar. When we look at treasury yields, so in other words, interest rates, when there was a lot of fear in the market, there was an expectation the Fed would have to step in and cut interest rates. Well, lo and behold, fast forward to where we are now, similar phenomenon, that now that there are less risks to the economy, interest rates have moved back higher. Not quite into positive territory on the year, but certainly big moves off the lows from the early April Liberation Day figures. Similarly, with the Bloomberg Commodities Index, a lot of that strength early on was driven by, steel on one hand, certainly precious metals. Gold had been a very strong performer. Gold still is mostly performed pretty well. But when we look at the broad commodities index, so precious metals, base metals, agricultural products, and energy, there was similarly a very heavy sell-off within the commodities index. And since then, we have seen that recovery. We're now up a couple percent year to date. And then on the flip side of things, we saw volatility do the exact opposite, which was absolutely scream higher. So volatility and fear in the markets went to levels that we really hadn't seen since the COVID lockdowns. And very, very quickly, as we've gotten clearer heads into the market and the added temporary delay on tariffs, or I guess reduced tariffs on China, we've seen the volatility index move back down to basically flat on the year. So just staggering moves within all of these indices. And then the one that's kind of bucking the trend a little bit is the US dollar. So we're looking at the DXY index, which is comparing the US dollar to a basket of global currencies. That's one that we've seen a fair amount of weakness, perhaps a little bit of the end of U.S. exceptionalism, if you will, taking money out of the U.S. economy and moving it elsewhere. But I will add, this is one that has not yet fully recovered back to year-to-date levels. It's really not even close. It's still down several percent. I would note that Trump historically has been a pretty vocal advocate of a weaker currency. He's a fan of a weaker dollar. A weaker dollar tends to be beneficial to U.S. exports. So maybe some of this is purposeful, but it is interesting to note that the dollar index is the one that does not look just like the other broad market indices. So you got to ask yourself, what in the world was the point of all this? If stock markets are back to where we were, inflation concerns are back to where we were, the commodity markets are back to being recovered, and we never got any interest rate cuts, then what was the point of all this? Well, I think maybe this is the art of the deal. Maybe I'm giving Trump too much credit, but it does feel like this essence of create a whole lot of turbulence, create this whole whipsaw effect and panic in the markets, all in an effort to get people to come to the negotiating table. And I would say that, again, not to give too much credit to this administration, because it has been a very turbulent 2 or 3 months, where we are winding up is at a higher tariff rate. The expectation from Goldman Sachs is that tariffs broadly on a weighted average basis across the entire world are going to go up by 13%. So it's not the 50, 100, 145 type percents, but we're landing in a spot, it looks like, that's going to be a higher tariff regime. So, it's one of those things where it's almost, blow everything up and then piece everything back together in a way that you ultimately were intending to in the first place. But it's not looking anything like where we were just 4 weeks ago, where we had essentially a trade embargo with most of our trading partners.
So if I'm hearing that right, like to build it up to the 10 or 13%, right? Blow it up as big as you can, right? Kind of the art of the negotiation, right? And then bring it down and ultimately come away on terms or at levels that you anticipated or
it feels that way. Because there could have been a chance that the administration could have just come out 2-3 months ago and said, we're going to put 10% tariffs on everyone that we have a trade deficit with. And I think the market probably would have absorbed that decently well. But what it may not have accomplished is getting other world leaders to the negotiating table to say, hey, what do you want? What's the actual goal here? So my assumption is there are probably a lot of discussions happening behind the scenes where there are trade deals, there are specific things getting carved out, there are certain exemptions that are taking place, but a lot of that may not have been achievable without causing the explosion first. And again, not at all trying to give the administration too much credit, but I think if I'm reading through all the noise, this kind of feels like what people describe the art of the deal as.
You haven't read The Art of the Deal?
I have
Between all
not
this?
read it. I have not read it. I've read a lot of excerpts of people's opinions about it, and a lot of them do kind of summarize this way, which is break everything and then rebuild it more in the eyes of the way in which you want it to be. So there is a material difference in the tariff regime as we sit here now, and potentially as we roll through over the next several weeks and months as we get more of these trade deals. But coming back to the UK deal, that's a heavy ally of ours who had a trade surplus with us, and we're still landing at 10% tariffs with them. So that's meaningful.
Yeah.
If other nations wind up in a similar percentage or maybe even higher because they aren't quite as good of an ally as the United Kingdom, then yeah, you would expect a pretty meaningful increase in these types of things.
Yeah, it's just the other thing, right? If it shakes out, it ultimately China's at 10 and allies like the UK are at 10. What does that accomplish?
Yeah, I mean, ultimately, it's still creating a bit of an incentive for U.S. companies to encourage them, maybe more lightly than we would have 2-3 weeks ago, but to encourage them to domesticate supply chains. And it's worth noting, even just this morning, publicly traded company Generac Holdings, they make generators up in Wisconsin. Their CEO on Bloomberg TV this morning said they are over the next 18 months going to continue reshoring their supply chains. And that's even post the Chinese news. So yeah, I think there is still generally a hint, nudge, nudge, like keep doing this. This is still what we want manufacturers in the United States to be doing. But the terms under which are going to be a little softer than where we would have been right around Liberation Day.
Makes sense.
Now, the bad news is we've already created a little bit of damage with the administration has already created a little bit of damage, uncertainty, volatility with regards to supply chains, demand, just business activity broadly. And this again is coming from Goldman Sachs. Their expectation is while the damage may be less than where we would have been 2 weeks ago with the moving down of these Chinese tariffs, it's still expected to create some demand headwinds over the next several months. The hope or the goal is that eventually this creates better long-term demand situations for the United States, but that side is yet to be seen. But Goldman's estimating somewhere around about a 1% GDP hit for 2025, just from the disruption that's already occurred. We avoided catastrophe with regards to some of these retail purchases, but you still created a situation where people are a little less sure about just how to manage in these business in this business environment.
Sure.
And very similarly, on the idea of this tariff roller coaster, we mentioned this either last Cup of Joe or 2 Cup of Joes ago, but the idea of GDP going negative in Q1, much of that, as we noted, was due to the fact that there was a lot of pre-buying, pre-tariff buying, and because of that pre-tariff buying, that caused the net import, or rather net export number to decline substantially. And the calculation for GDP is consumption plus investment plus government spending plus net exports. That last bit, that net exports figure went so heavily negative. In other words, we were importing so many dollars worth of goods that it took the GDP number temporarily into negative territory. There were a lot of economists who were saying, feels like we're already in recession. Well, fast forward to where we are now, the GDP now index is already back above 2%. So,
Okay.
Similar to the stock market, similar to a lot of those other broad market indices, so to have recession fears moved off the table with the market getting a bit more digestible environment. So,
Yeah.
a lot's happened. At the end of the day, I think we kind of have to take a step back and say, it looks like the administration is still very serious about these types of measures of saying we're going to encourage manufacturers in the United States to bring things back locally, or back to our friends. But the terms under which are much less persuasive than they would have been 2 weeks ago. So I think that's a bit of good news for markets.
Help me line up the timeframes with our North American counterparts, right? Mexico and Canada, they were in the 90-day reprieve announced a few weeks ago, right?
Yeah,
and China just now. So like kind of similar time frame, but like any updates with Canada and Mexico?
Yeah, I mean, there is a little bit of confusion, I would say, in the markets where it's like, why in the world are we Are we coming
Yeah.
to terms with China before we come to terms with some of our best friends? I honestly think part of that is because we had to. Like if we had disrupted things with China for too long, we actually get a very catastrophic situation in availability of things. I think that's the only reason why. So with that said, now that we've gotten that back down into a more reasonable zone, I do still expect places like Mexico, places like Canada, South Korea, India to get some announcements here in the coming weeks and months.
Okay. Yeah, I guess coming back to the metal buyer, what does this mean now? I know there's probably a near term and a long term answer to this, but what should metal buyers be thinking about now with all this news?
Yeah, so again, I don't think we're through the volatility just yet. My guess is there are going to be a couple countries who probably anger the administration, and maybe we get some more headlines of, well, we're going to be mean to this country or this country, and that's going to create volatility in markets. But as we think about what's happened in the last 2-3 weeks for metals prices, I'll focus first on base metals. They've all done a similar phenomenon to what we saw, let's say, in the stock market, where things got very panicky around that Liberation Day. And similarly, aluminum traded off about 20%, copper traded off about 20%, nickel traded down about 15%. Since we've gotten a little bit cooler heads within the market, we have similarly seen recoveries in the prices of things like the London Metal Exchange aluminum price. It's gone from about $1.05 to where we are now is right around $1.13, $1.14. So about a 10% recovery. We're not back to where we were pre-Liberation Day. In the case of nickel, similar thing, we got down as low as about $6.40. We're now back around $7.20. So somewhat meaningful move there of 10 to 15%. So kind of back into the realm where we would have been pre-Liberation Day. And then copper, similar story, not back to all-time highs, but back into the mid to high $4 per pound range. The one that bucked that trend is going to be carbon prices, which, if you recall, carbon prices, we called on the last cup of Joe that it looked and felt like they were peaking out somewhere in the mid 900 range for hot rolled coil. We had begun several weeks ago, and I think we're continuing to see just a little bit of softness within that market. And if I were to peg, where current hot roll prices are, we're somewhere right around $900, either side of $900 by a couple bucks. That's where Nucor CSP is now. So that one has been a little bit more immune to the turbulence of the Liberation Day and all those things. So that's the one that's actually gone a slightly different direction.
Yeah. Okay. All right. So sounds like still encouraging of the domestic steel production, right? Right. It's still priced better than import.
Yeah. So our market is still certainly the highest of the global prices. It is. We didn't have this news 2 weeks ago, but it is perhaps worth noting that Cliffs, which is one of the biggest steel producers here in North America, they did announce that they were idling, I think it was 6 facilities, all in an effort to be just more efficient of an operator. And so that, all things being equal, probably raises the floor under which steel prices ultimately bottom in this cycle, because that should help to keep some production subdued for the next several months. So that's a bit of a news element that we should probably highlight as well.
6 seem like a lot. I don't know, how many do they have? Are we talking?
Yeah, I don't have the exact number of all of their facilities, but if I recall correctly, it was more of their non-core assets. Okay. So it's likely not their largest auto supplying facilities, but it's all in an effort to basically say we need to preserve cash, we need to pay down some debt, we need to get our ducks in a row as a business. But anytime you're taking production offline, that should help to dampen the downside and how far prices ultimately go.
Makes sense. Okay. All right. Well, Nick, always on top of it. You got well prepared for this, and we're it's just a changing story all the time, and it's fascinating. The right word is it?
Yeah, it feels like a TV show every single day, but I'm sure we'll have more to discuss live here in 2 or 3 weeks on the next Cup of Joe, and I look forward to it.
Great. Thanks for joining us.
Excellent. Thanks, man.